If you've ever wondered what it takes to buy a house, but you're not exactly sure of the steps you take, I'm going to talk to you today, friend to friend. I mean, look at me. I got a backwards hat on and a black V-neck t-shirt. I'm not here to be fancy. I'm not here to be formal. I'm just here to give you all the details. I'll tell you quickly in case you're wondering who I am. My name is Aaron Page. I'm a mortgage broker. I've been a licensed mortgage real estate professional for over 13 years, going into year 14 next month in May. So when it comes to buying a home, I do know a few things, having seen thousands and thousands and helped fund over $500 million in 13 years for people around the United States on new home loans. So let's just jump into direct get pre-approved, okay? What does that mean? What that means is you're basically laying out your whole entire home buying roadmap for the lender, the credit union, the bank, whoever you're using. You're giving them the roadmap of your credit history, your income history, and they're going to make a determination on if you're qualified enough to be able to buy a home. Now, that's a very high level view. Let's just break down really quickly what you need when you go to get pre-approved that the bank, credit union, or mortgage broker is going to need to fully pre-approve you. You can expect to do an application, whether it's in person or online. It's kind of old school nowadays to do it in person. Almost 99.9% of things are done online. So that's what I would expect. You're going to fill out an online loan application. And then towards the end, there's most likely a secured document upload portal where you can upload the following items. Now, this isn't an exact list because everyone's situation is different. Like if you're self-employed, different things are required versus W-2 employees. But here's a quick overview. In most cases, you need your most recent 2 years of tax returns. So that in this case right now would be 2022 and 2021. 2023 is going to be due here in a few weeks, but if you file an extension, they just need a copy of the extension and your last 2 most recently filed years of federal tax returns. We don't need state returns. Your most recent 2 years of W-2s or 1099s. You'll need your most recent 60 days of bank statements to show that you have the funds to close or at least some kind of skin in the game for the earnest money. We need to see bank accounts with funds in there and hopefully nothing negative like overdrawn accounts. You'll need your most recent 30 days of pay stubs. I say it that way because some people are only paid once a month, so they'll only need to provide one pay stub in order to cover a 30-day window. If you're paid every 2 weeks or bi-weekly, you'll need to provide your last 2 pay stubs to give a 30-day range of coverage. Lastly, this one varies by lender, credit union, or bank. I always have to ask for photo ID and any retirement accounts that just show reserves. The reserves aren't required, but if you have them, it always builds a stronger profile for you in the long run. That right there will take you through the pre-approval stage. So application, paperwork takes 24 hours, sometimes even less. You'll have a mortgage pre-approval. You'll figure out what you can afford. You'll talk to your loan officer. They'll give you interest rates, payments, the breakdown, make sure that you're comfortable with it. And then you can move on to step number 2. Step number 2 is an important one. And I'm not going to say controversial, but a lot of people don't like when I say this. You need to find a realtor that you trust. Just because your parents or your aunt, uncle, cousin, whatever, they're a realtor, or they used this realtor when they bought their house and it's been the family realtor for 25 years. That's fantastic, but my style is completely different than my parents' style. I don't need the same realtor who wants to have a cup of coffee and write down our needs. Like, I want someone who's going to take me to a house in 45 minutes if I want them to, and they're ready to go. So do your research, ask your friends, ask your family, but in the end, you need to find somebody that works really well for you and what you need. If you get a realtor and you call them at 2 o'clock and they can't get you into the house until 8 p.m. that night, or maybe they say, I'm not available until 10 a.m. tomorrow morning, that house in a very competitive market, when we get back to that point, most likely is going to be sold that evening, and you're going to be out in the dark. No one's going to know what's going on. You're not going to have an opportunity to even put an offer in. And if you do, you're going to be 4th or 5th on the list. It pays to be the first one in. That's all I'm saying. You can get into the house first, be the first offer in, you're the first offer presented, you can see how it works in your favor. Once you've interviewed a few realtors and you've determined who you're going to use, you'll go out and look for your home. Now, I'm not going to speak on the realtor piece because I am not a realtor. I'm a mortgage broker and I know my lane, so I'm not even going to dabble in it. But essentially, you and your realtor are going to find out your needs, find out what you're looking for, and then you're going to go out and find that home, put an offer in, it gets accepted. That's where me as a mortgage broker, I come back into play. I get you pre-approved, you go find your home, and then once you're under contract, I come back into the fold here. The minute you're under contract, your realtor is going to schedule a home inspection. Now, this is optional, but I would never, ever skip my home inspection. And there's a few reasons for it. Home inspection can bring up any problem with the house, and home inspectors are very, very good at what they do. They get in the attic, they walk on the roof, they look for holes, they look for mold, they look for electrical issues, they test every single outlet to make sure there's no faulty wiring the best they can. My home inspector pulled out my dishwasher and my fridge and looked underneath it to see if there were any dripping water lines. I don't know if that's common, but I love the fact that he did it. So getting a home inspection is your first view of the bones of the house the best you can without obviously knocking down walls to see what the inside of them looks like. A home inspection can range anywhere from $300 to $600. It typically varies on the size of the home, but I promise you, it's one of the best insurance policies that you can get to see what the inside of that house looks like that you can't see on the surface. Once you're under contract, you're getting your home inspection. At that exact same time, me as the lender, I'm working on your initial disclosures. Now, these are the initial upfront set of disclosures. Nothing in them is binding, so not everything's going to be 100%. I wish it was, but there are some variables we just don't know, and it can be little things. Like your initial paperwork might not have that the home was built in 1971. That's not a big deal, but I'm just saying these documents can change over time. The only time you're going to be bound to anything you sign is when we get down to our last steps, which we'll talk about coming up, and that's at the closing table. So you're going to get quite a bit of paperwork throughout the loan process. It's just how it is in the lending world. There's disclosures for everything. So again, during this time with the home inspection going on, I'm going to be working on your initial disclosures, getting all your paperwork set up, going over interest rates again, because you can't lock in your interest rate until you identify a property and have a contract. The interest rate lock actually ties to the property address. So in most cases, there are some weird programs out there where you can lock while you shop is what it's called. But in most cases, it's very expensive to do that. So you can't actually lock in your interest rate until you're under contract, which means if you got pre-approved 2 weeks ago and now you're under contract, rates can change a lot in 2 weeks. Like for example, yesterday on April 10th, I had 5 different reprices on my interest rates. So they changed about every hour and a half while I was working. I'll stop rambling, but initial disclosures, big packet of paperwork, probably 130 pages, electronically sign them, review them, read them, ask questions. Nothing's binding in them, but they are important, so make sure they're accurate. Once your disclosures have gone out, you move into the next stage, which is processing. So when you move into processing, your appraisal has been ordered, which when your appraisal happens, they're not doing as thorough of a job as a home inspector does. They're going out and they're basically looking at the home, making sure if it's a 3-bed, 2-bath, that it actually is a 3-bed, 2-bath, that it matches what's listed with the county, the square footage, and they're going to look for other comparables that compare to your home that have recently sold in order to determine a value of the home you're buying to make sure it's worth your agreed on purchase price. So while all of that is happening, processing is actually working with underwriting and with title and escrow, and they're getting all of your documents. Plus, we're probably getting more from you during this time too. Is what we see most if we do all of our work up front, like we referenced earlier, the tax returns, W-2s, pay stubs, bank statements, photo ID, retirement accounts, all of that stuff. If your loan officer does a good job getting that up front, it should make the processing and the underwriting stage very simple. Is what you can expect during the processing stage is letters of explanation and, hey, there's this deposit or there's this ACH transaction going out to the IRS. Are you paying a monthly installment on taxes and things like that? There's a lot of clarifying items that happen during this time. So processing is basically packaging your file up the best they can to send it into underwriting, who gets the ultimate and final say on your approval. This leads us right into our segue for underwriting. Underwriting typically underwrites off of Fannie Mae and Freddie Mac. They're the two leading people, or companies I should say, behind mortgages in the United States. They set guidelines for lending in the US. The underwriter is looking at your file, all the documents you've provided, they're comparing it to guidelines, they're looking at automated findings and guidelines, which we have a system we can run that basically conglomerates everything together and says, this person fits this bucket on an FHA loan or a conventional loan. It comes with a status called approve eligible, which is an automated finding. And in order to fit guidelines, there will be little mini conditions on there that you have to satisfy. It tells us what we need, and we underwrite off of that to make sure that the loan could be serviced and insured by Fannie Mae or Freddie Mac. Now, underwriting could be very easy. It also could be very difficult. It depends on how many moving parts you have in your life. Unfortunately, self-employed people typically have the hardest time in underwriting because your personal finances are being looked over, your business tax returns are being looked at. There's all these variables, but that doesn't mean for W-2 people it can be any less stressful because there are things that can pop up during underwriting. Like I said, they're the ones that have the final say, and they need to make sure that you fit guidelines so Fannie Mae and Freddie Mac will insure and back the loan. Now, in my 13-year career, I've had plenty of files that go into underwriting one time. We packaged it up beautifully. The underwriter loved it. They gave us our clear to close and we were moving on. One time they looked at it, said, hey, this is perfect. And then you're on your way. I've also had the complete opposite of that with files where we've had to go back to underwriting 7 times. I mean, sometimes underwriters can be nitpicky, put their heels in the ground and say, I need more clarity on this. And you're writing a lot of letters of explanation. You're getting extra paperwork. You're getting documentation. And typically is where you run into a holdup, let's say, in this stage, is if what you provided just doesn't seem to line up. An example of that is this. You give me pay stubs that say you work 40 hours a week. You're full-time. We have it for 30 days. We see the deposits, but we do a verification of employment. And let's say it's now April 11th today. Let's say January, February, and March, you were only working 25 hours, but you knew you were going to buy a home. So for the 30 days leading up to getting pre-approved and buying that home, you talked to your boss and said, hey, I'm going to try and buy a home. I need to be at 40 hours a week for a little bit so I can qualify, and then I'm going to drop my hours back down. They start looking at averages and say, if you really were working 40 hours a week, your year-to-date income would be a lot higher. Explain it. Why? Why is it not? And then it's on you and your employer to justify if your 40 hours a week is going to continue, or if you were part-time January, February, March you went full-time, and now it's April, you're in the middle of buying a home and you're going to close and drop your hours back down. They're basically preventing or trying to prevent any kind of employment tricks where you could potentially make less money and just make it look like you make more for the purpose of qualifying. So there are a lot of things like that that can come into play. That's just one example. Of course, there's many examples of why underwriters can ask for certain things, and we have to keep going back and forth. Once we clear underwriting, the next stage we move into is actually getting to closing. We get your closing disclosure out, and the closing disclosure is the first piece of documentation where you actually start to see your final closing numbers. You get balanced up with title and escrow. This is your down payment. These are all the fees on your loan. This is how everything breaks down. It's going to have your cash to close. So you start getting a realistic picture of what it's actually going to cost to make this loan close and make it happen. Now, this is the time. Like I mentioned, the initial disclosures earlier, those are variable and they're going to change over time. Your closing disclosure needs to be accurate because your closing documents are pretty much based off your closing disclosure because that's the structure of your loan. So if your closing disclosure is off, the interest rate isn't right. Your taxes and insurance aren't right. You have fees on there that you were told were going to be removed, but they're not removed. Make them be removed. Do not sign it. Say, hey, we talked about this. It's still showing on here. Don't give me the whole I swearsy it'll be gone on my closing documents. I don't want it on there. I'm not signing it until it happens. A lot of people may bark at me for that one, but it's just simply how it is. Because if you sign it, you have a 3-day wait period. And there's a cool down period after you sign that. So during those 3 days, that's when your closing docs are going to go out. But how do you know those fees were actually removed? And then Monday, you're going to go sign your closing docs and you get there and it's still on there. Well, then you're kind of being pigeonholed to make this loan close because your closing docs aren't right. So all of this stems from the closing disclosure. Closing disclosure will drive the closing docs. Make sure they are accurate. Once your closing disclosure is out, then your closing docs go to title and escrow. And the only thing left for you to do is go sign and fund. Typically that happens the same day. It just kind of depends on your setup. If you're under the gun and your close date is tomorrow and your signing appointment is tomorrow, then you have to sign early in the day to make the wire cut off so you can sign and fund the same day. If your lender is really on top of it and you're a week ahead of time, you don't close until next Friday, go sign whenever you want. You could go sign tomorrow and then next Friday, the wire will just be there. It's stress-free and you're ready to go. You close on your home. The last step is once you've signed and funded, the county that you live in will actually record the deed and all of these documents in public records as you are the owner. So technically, once you fund the loan, you can't go take possession of the house immediately. Recording can happen anytime from an hour after you sign to 4 o'clock that day. When your realtor gets a call and you get a call that the loan is recorded, you own the house. And if you want, you can go kick the front door in because it's yours and you're the one who has to fix it. I hope you guys found this information helpful. If you did, please subscribe to the channel. We're working on some new content. We're trying to talk to you like real people. We're not trying to sit up here with a suit and tie. Like I said, I have a backwards hat on and a V-neck black t-shirt. We're doing it casual because mortgages can be casual, and getting information that will help you in the future doesn't always have to be stuffy and uptight and you're watching some weird animated video. We're here to help. Ask any questions you have, and we'll see you on the next one.